Now, one of the things that's taken grip and center stage this week is the IPOs, and within that IPO frenzy, there is HDB Financial. Welcome, you're watching KYC, I'm Harsh Saita, and today we're going to focus in on HDB Financial. 3 or 4 parameters that really pique interest with regard to an HDB. One of them being the fact that it's owned 74% post this IPO by an HDFC bank. But what you want to see is whether there is a real large risk of that holding coming down to 20%, because that's what the RBI draft norms are pushing NBFCs to do. And within all of this, of course, is the fact as to whether you should subscribe to the IPO or not. And we'll get some insights from analysts on this entire RBI issue possibly, which could come up with regard to an HDB. RBI in a very different mood and therefore may not materialize as well as a risk, but we'll understand that risk better. The second piece is the interplay between growth and valuations. It's a decently fast growing company, and the IPO valuation is something that we'll highlight, compute and give you a deep dive on as to how you should look at. And we'll also ask analyst, one of the analysts who we're speaking with today, as to how he looks at both the price to book valuation as well as the 1 year forward and maybe the next 3 years that he sees with regard to this one. The promoter ownership shrinking, that's the third risk which I'm talking about, and we spoke a little bit about that risk. It'll come straight up on your screen. There you go. And whether this business is highly cyclical, how should we look at the business? Because you have HDFC Bank on the one hand with a very stable lending business trading at 2.5 times price to book. And then you have this business. Is it slightly chunkier? Is there a risk and high level of cyclicality within this, or can that cyclicality stabilize? And yes, in the good years, will it be extremely good? And in the bad years, can it maintain status quo? Even a 2% ROA is not bad in a bad year. And that's what I want to understand better. And fifth point being, can it sustainably continue to generate profits? I want to pull out one nugget. In the last 8 years, HDB Financial has not done a fresh equity raise even once. So from its loan book size of 35,000 crore to the current loan book size of 1,06,000 crore, it's not done one fresh equity raise, other than ESOPs, of course, which is a big thumbs up, right? There you go. So what you want to actually understand is whether this profitability can sustain going forward as well. Again, even in the IPO dilution, it's a small dilution that they are doing with regard to fresh issue. It kind of raises the question that sustainably, our ROE ratio is just significantly strong to take care of growth. And we'll try and dissect some of those angles as part of KYC today. Let's though first off start by understanding what HDB Financial actually does. Let's start from scratch. Let's pull out the RHP. For those who haven't read it, let's pull out the RHP and do a little bit of reading. Well, it was incorporated in 2007. It's a retail-focused NBFC. So while at its core, it's not retail like a Bajaj Finance, but it does lend to individuals and small businesses. And that's why that granularity is what causes it to be called a retail-focused NBFC. And it's the 7th largest retail-focused NBFC in the country. It covers around 1,170 towns and cities. It's spread across 31 states and union territories. So even in terms of the diversity in terms of geography is very large, right? Which causes more granularity. It also brings in an element of stability, because no one region impacts the book as a whole. It has 1.92 crore customers. This has gone up from 1.2 crore customers in FY23. So just look at the growth in the customer count, which is getting added in the last 2 years alone, is nearly 60 lakh customers. So 50% of all its customers combined since 2007. 50% of that, or rather 30% of that, 33% of that, it's done in the last 2 years alone. That just goes on to show that the scale is starting to pick up. It has over 1770 branches and has an average ticket size of its loan is around 1.65 lakh. This shows how granular the loan book is. In fact, when I was reading through, the top 20 borrowers comprised less than 1/3% of the cumulative book of the NBFC. That kind of shows how granular it is. Now let's talk a little bit about what's unique with regard to HDB. I've already spoken a few things about what's unique, but let's talk about this, the macro factors that's unique. 80% of the branches are located outside of India's 20 largest cities. Over 70% are located in tier 4 plus towns. I also want to talk about how it's more focused to underserved and underbanked customers. That's the larger focus. And the low to middle income households with minimum or no credit history is what they cater to. In terms of a little bit more on that low to middle income households with no credit history, around 12% of the loans are to people or persons with absolutely no credit history. You want to take note of that number because that also presents its set of risks, but it also lends to the fact that if they have been doing this for so many years, they've got some formula right, and therefore you want to look and pick as to whether that's a risk worth taking or not. But that's broadly what you should know. Let's talk about the business now. It's obviously into lending. Let's talk about enterprise lending. That constitutes around 40% of the book. Business loans, LAP, gold loan, and salaried personal loan. These are the constituents of enterprise lending that they do. Let's talk about asset financing. Again, around 38% of the book. Tractor, CV, and CE loans is what it caters to. And then there is consumer finance, and there are a whole bunch of consumer finance loans that they give, which contributes around 23% of the book. Asset finance is fully secured, and 73% of the loan book along with it is absolutely fully secured. Of course, in case of a default, there are certain processes which kick in and take time to kind of liquidate assets, but it lends some amount of comfort to the way in which the loan book shapes up. Let's look at the metrics that we look for in an HDB financial. We start off with the income statement, balance sheet. We look at key metrics individually, which includes yields, margins, ROA, cost to income. We'll also look at the asset quality of the financier. We look at shareholding pattern, valuations, and we look at risks. This is slightly different because street coverage is not something we have. So again, that is a key component. Let's quickly look at the income statement. You look at the net interest income growth. It's been at roughly 17% odd over the last 2-year CAGR. The operating profit has grown at a 41% CAGR. They're also doing, mind you, they also do back office services for an HDFC bank. So that contributes to the other income line and the other services that they provide. Provisions has in fact gone up in FY25, and that's why you're seeing that CAGR number quite high. Profit is up just about 5% due to the higher credit costs that we've seen. And therefore, any tapering down on the credit cost could well aid profitability if that were to happen, and any increase in the credit cost could cause cyclicality to profitability. This is a risk we've spoken about. We've given this a neutral because of exactly and precisely that reason. Let's now talk about the balance sheet and look at the way in which that one has grown. Last 2-year CAGR has been 24%, 3-year CAGR has been 20%. So decent growth on the balance sheet front. Borrowings is up around 26 odd percent. When you're also looking at the capital adequacy, it's very, very healthy. Mind you, you want to note those 2 points that I spoke at the start. The first point being that in the last 8 years, they've not done a single equity raise. Extremely solid, and profitability is basically what is driving growth here. And the second piece, of course, of that is that in the meantime, your gross loan book has gone up from 35,000 crore to 1,06,000 crore. So growth has been extremely strong as well in those years. But a 20% 3-year growth is not bad at all. We'll give this a thumbs up with a 19% capital adequacy. Again, not looking bad. Let's look at the key metrics now very quickly. Yields are at 14 odd percent. You see your cost of borrowing is roughly 7.9% for FY25. So again, that is not bad, and it gets advantage with regard to cost of borrowing because it's the subsidiary of an HDFC bank, and that kind of gives it a little bit of leverage in terms of cost of borrowing versus its peers. even within the same risk bracket. When you're looking at margins, they've come off slightly, but that's how the rate cycle has also progressed. With this rate cutting cycle starting, it could well aid margins as well going forward. Look at ROAs. ROAs have come off in this year, and that is because you've seen some bit of credit cost spike which has happened, and therefore that is playing out on the ROA number. But look at how cost to income has evolved as a result. Credit costs increasing, they've tapered down on their cost to income. 49% is where that cost to income currently lies, which is also elevated. But nonetheless, this looks like a decent set. 2+% ROA in a tough cycle is not bad. 3% roughly in a decently okay cycle is again very, very creditable, and therefore we've given this a thumbs up overall. Let's look at asset quality metrics. Your NPA ratios have come off but have bounced back up in FY25. We spoke about this, and your net NPA too has bounced back up. This will see cyclicality on a year-on-year basis, and it will depend on how the business and the cycle, credit cycle is evolving, and therefore we've given this a neutral, but it's fairly controlled. Given the kind of borrowing or lending that it does, this is not a bad net NPA ratio to have, which is sub 1%. So they're providing well with regard to their NPAs. Let's talk about shareholding now very quickly. You're looking at promoter holding, which is at 94% currently, expected to fall to 74%. Right? Now, the real risk here is if RBI's draft norms are implemented and this promoter holding is mandated to fall to 20%. Two reasons why this will happen. One is if there is no distinction or distinct lending, which HDB Financial does versus an HDFC bank, it's a very real risk. They've carved out this risk. So you want to keep your eye out on that. The second is, of course, if they continue to hold HDB Financial and don't merge it into the bank. These two could well translate, and of course if the draft guidelines are made final in its current state, these are key risks with regard to shareholding pattern as well, and hence we've given this a neutral. You want to wait and watch how this one evolves. This is a key risk for every holder of the stock. Vishy joining me as well. Vishy, any thoughts on this piece?
Yeah, so as what you were mentioning earlier, that there are certain risks that are inherent, Harsh, to this kind of business, especially the point that you made about the subsidiary guidelines of the RBI. Now, that is a bit of a roadblock especially as far as HDB Financial is concerned, because HDFC Bank owns the majority stake, currently 94%, post this issue about 71-72% that they're going to hold in the NBFC. And if the businesses are not materially different, then it becomes a real choke point. But of course, it is incumbent then upon the management of the NBFC to convince the regulator that, yes, they are similar umbrellas, but we are entirely two different entities doing supporting two different types of clientele. Remember that was what is the RBI's major concern, that you don't want the same group to lend to the same entity through multiple lending arms. So that is something that the RBI wants to avoid. And if they're able to convince the RBI that this is how the businesses function, then things might look a little bit better.
Right. So that's with regard to the shareholding pattern, something you should keep an keen eye out on. Let me look at valuations now. It's currently trading at the list price to the book value, or the IPO price to the book value, not the list price. The IPO price to the book value is 3.7 times. But that's not the right way to look at it. You have to look at the book value post the equity infusion. And the book value post the equity infusion is 3.33 times. That is the current book value post equity infusion. This, on a one-year forward basis, could well be 3 times. And I'm assuming that last year's profit after tax will continue in FY26 as well. That's a conservative estimate. A lot of analysts on the street are estimating a slightly better one-year forward price to book, but we've been conservative here. Doesn't look particularly expensive, but doesn't look particularly cheap either, and therefore we've given this a neutral, Vishy. And the last piece is with regard to risks. Now, we spoke about at length about how the promoter may be required to substantially reduce ownership to less than 20%. Seasonality, which impacts the business, we've spoken about this. Non-payment or default by customers. A lot of these risks are also highlighted in the RHP. So if you do have the bandwidth, please do read the RHP before you subscribe. But even if not, we've covered the key risks here, so it kind of gives you a good lens. Also, secured loan defaults will likely lead to risks to enforcing collateral, which has its own set of procedures and practices. Offer for sale is 10,000 crore, which is a large chunk of the IPO. Conflict of interest with HDFC Bank, of course, both lend to, or rather are lenders in itself. Trademark and license agreement is present with HDFC Bank. Volatility in interest rates impacts the numbers, and competition, of course, is starting to rise again in some of the pockets where HDB Financial lends to. Last off, I want to also talk about how the street is looking at this. All analysts have an apply on this one. Let's quickly stack up all the ratings, and that gives us overall a 5.5 out of 8 on our KYC ratings. We'll have that on the screen in just a minute. There you go. So that's the rating on KYC. Let's go across to Shripal Doshi. He's joining us, research analyst, NBFCs and SFBs at Equirus Securities. Shripal, great having you. Apologies for the slight delay that we've seen. Let me start off by asking you, how do you look at the risk of HDB Financial having to go through multiple cycles? Because the ROA cyclicality is evident. So how should one view that?
So, good morning, Harsh, and thanks for having me. So with respect to the volatility in the ROA, it's a function of the product mix also, if you look at it from that angle. They have a product portfolio which is across 13 subsegments, right? So while you have highlighted the 3 key categories, but then within that there are 13 products, and those products have gone through turbulent times, let's say post-COVID twice. So in FY21-22 was a period wherein those product segments led to higher credit costs, not only for HDB per se, but at system level as well. And then also in FY25, we've seen that trend, let's say in segments like CV, in segments like personal loans, some of the retail loans. So therefore, the volatility in the credit cost leading to volatility in the ROA. However, if you look at it from the diversification point of view, it is still a very, very well diversified franchise, decoupling itself from one particular segment and the turbulence in that particular segment. So while there is volatility, it is the best probably in terms of diversification that a franchise can have to sort of decouple itself from these credit cycles or credit cost cycles.
Well, Vishwanath here. I just wanted to join in this conversation and ask you a couple of questions, specifically around the OFS bit. Now, HDFC Bank is going to offload shares worth 10,000 crore. Now, that's the stated goal that the bank has stated. Obviously, that will bring down a shareholding. Do you at any level see it as a material risk that the promoter is offloading a sizable chunk? And out of the 12,500 crore, this is a big part of this entire issue.
So see, this is also with respect to bringing shareholding to, let's say, 74 below 75%, right? Which is one of the requirements by the SEBI. So it is in sync with that, and I do not see so far any risk on of this shareholding coming down to 75% or 74%, being very specific there. So I do not see any risk there because it continues to enjoy the AAA rating on the credit rating side, right? By most of the credit rating agencies. So bringing it down to 74% doesn't really have any impact on the credit rating or on any other operational aspect of the franchise.
Shripal, can they in some way circumvent the RBI regulation? And I'm assuming that this regulation becomes final, can they circumvent it by saying that they're doing a different business, it's a different cohort, a different set of clients that they handle?
So see, they are into different customer target segment actually. While the product portfolio is an overlapping product portfolio, or rather because they're into diversified product segments, right? But the kind of customer segment that HDB caters to is broadly different, or let's say relatively inferior versus where HDFC Bank is sort of positioned. And to your particular question on draft circular and its implication, So see, we'll have to wait and watch how the RBI comes out with the final version of that circular, because if they require the shareholding to sort of get trimmed down to a particular percentage, that could have an implication on how credit rating agencies look at these NBFCs at large. I mean, I would not only keep or contain myself for HDB, but also for some of the other bank-backed NBFCs such as Canfin Homes or let's say Fed Bank Financial Services or PNB Housing. So that will impact all of these guys from where the credit rating agencies look at these NBFCs, and that can have some impact on their cost of fund or their ability to raise funds at a lower rate from some of the banks or some of the financial institutions.
Shripal, one of the points that came out when we were talking to the management as well, this is before the opening of the IPO and as well as last evening, they're a slightly more conservative lender as such in terms of the way the business is structured. If you see the last 3 years of their asset growth, it's about 23% on a CAGR basis. Do you see that as a good sign, or in an industry where high growth is the norm, does that become an impediment at all?
So see, I was looking at the segments that they are into and what is the credit growth opportunity in those cycles for the next, let's say, 3-5 years time period. They are into product categories wherein the growth is anywhere between 15 to 20% CAGR. Be it, let's say, gold loan, be it the business loans that they are into, be it LAP or other categories as well, CV as well, right? And if you look at so there is an opportunity in the segments that these guys are present into. And to a particular question, how they have done in the last 3-4 years time period, rightly said, the CAGR growth has been 20%, which is relatively conservative. But we should also keep in mind that in the last 4-5 years, we've seen two high credit cost cycles after COVID, like let's say FY21-22 and also in FY25. So therefore, also optically, the growth CAGR looks little contained at, let's say, closer to 20%. But it is a franchise which delivers or which is very well positioned to capture higher market share in a good credit growth cycle. So when
Perfect.
this credit growth cycle improves, we will see growth also reviving.
Right. Shripal, how do you look at valuations? Any listing gains you're penciling in? Given the credit risk, just give us that perspective.
So see, with respect to valuations, if you look at on FY26 and FY27, as per based upon our estimates, it should be closer to 2.9x multiple for FY26 book value and closer to 2.5x multiple for FY27 book value. And so basically, we are not penciling in a very strong, let's say, peep of growth. But the PAT growth will be relatively higher, because if you look at in FY25, the credit cost was higher, which will sort of moderate in FY26 and FY27, which will lead to better PAT growth and leading to better book value accretion as well. So that's the sort of multiple that we believe the franchise is coming out at. And if you look at the other companies, let's say other diversified lenders such as Bajaj Finance or even Cholamandalam Investment and Finance, they are trading at a much premium valuation. So whereas from the parentage point of view, all of these guys come from a similar pedigree of parentage or promotership. So there is I would say at current valuation of 2.5x on FY27 book value, it's a fairly valued franchise with a upside possibility if the ROA improves to actually, let's say, 3% sort of a trajectory in FY26 and or even in FY27.
Excellent. Thank you, Shripal, for this. It's great getting perspective from you. Thanks for coming in, speaking with us. Completely out of time, actually, on this edition of KYC. From Vishy, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.